everybody, welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy, I'll be presenting. As we get started, keep in mind, as always, that there's risk involved with each trade that you take. No one trade is guaranteed to bring profit, so you want to manage risk in a way that makes sense for you. Also keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Now we'll go over some ideas with risk management as we simulate a trade or two, if we find some that look nice. And you'll see how the order window in our web trader and also in our app, all the same functionalities are in our app that you'll see in our web trader. You'll see how the order window helps you calculate exposure and potential profit, so you never go into a trade without understanding the risk side of things. Now as we log in the upper right hand corner here from the main website, we'll be in the web trader platform, which, like our app, allows you to trade on both MT4 and MT5 accounts from the same location. Now we're focusing on fundamental analysis today. Obviously we'll look at the charts as well as we look at maybe potential trade setups, but we'll start on the fundamental side of things for each potential move that we might do on a particular instrument. So just the backstory leading into today for the major fundamental kind of macroeconomic things that have been going on. The US seems to be kind of barreling towards more rate cuts, and the expectations have gotten higher and higher that will be the case as more and more data has come in showing really a weak job situation in the US. And now it's coupled with a government shutdown, so we didn't even get to see the latest NFP data out of the US, and the Democrats and the Republicans are still kind of haggling back and forth, if at all, in terms of negotiating. There doesn't seem to be much going on right now, and the government shutdown seems to be at an impasse in passing a resolution moving forward for the budget. It seems as far away now as it was 2 weeks ago when the government shutdown first happened in the US. So there's some negative sentiment there on the markets. The positive side of things, though, seems to be in the past couple days winning out. And the positive momentum is what we alluded to. There's a larger and larger expectation of maybe more aggressive rate cuts in the US, and paired with what they're calling quantitative easing, easing of monetary policy to allow for a bit of a looser market now. So the feeling is inflation has been enough under control now in the US that they're more worried about the negative effects of high interest rates on job creation than they are trying to bring inflation down any further. So the rate cuts began with the last FOMC meeting. Jerome Powell and the committee agreed to lower the interest rate 0.25%, and it looks like they will do that and then some moving forward, maybe a couple more rate cuts before the end of this year. So markets are optimistic about that. There's also been some nice earnings numbers coming in from various companies, and that's kind of buoyed the markets as well. The other negative story that's kind of put a cap on things and why the markets aren't at a new all-time high just yet is the China-US trade situation. Trump threatened at the end of last week 100% tariffs added on top of the already existing, I think, 25% tariffs or so that are on China. This was in relation to rare earth metals and the dealings that China controls something like 90% of the rare earth metals in the world, and they, I guess, made some maneuverings to create trade barriers for other countries, and Trump reacted to that, not just on behalf of the US, but on behalf of maybe the rest of the world that's involved with AI and chips that depend on those rare earth metals. So electric car vehicles as well. There are a lot of segments of technology sector that depend on these rare earth metals, and so that's where that threat came from. But the fear from that crashed the market last Friday, and it seems to have rebounded from that. So that's just on the back burner, it feels like. The momentum seems to be positive right now on the markets from a larger sentiment perspective, but a headline just like that, could reverse it. And so if there's a negative headline about China and US trade situation, you could see the market pull right back down. If there's a negative headline about the US government shutdown and it looks like it's going to go from bad to worse, well, then you could see the markets pull back down again as well. And we're talking about US trade situation and US government shutdown. But when I say the markets, I mean globally, because the phrase goes, when the US catches a cold, the whole world sneezes. And so that rings very true with the markets. It's very much a global market anymore. And so we really, the biggest storylines right now have been out of the US, and largely because of the way the Trump administration handles things, with quite a bit of zest, you might call it, or aggressiveness with the policy. So we need to keep an eye on the US-China trade situation for any new headlines, and also the other driving stories, because those headlines obviously could reverse things. So while there seems to be positive momentum right now, on the risk side, you want to risk manage, because you need to be aware that those other storylines that seem to have died down a bit are still there. Okay, so that's just a word of caution as you go into your trades. No matter how good they look right now with the current momentum, you also want to consider the risk side and manage that, because you don't know when that next headline or post on Truth Social or wherever it is that Trump might do his next post on social media might come and swing the markets kind of within the moment. Okay, all right, so moving forward today, volatility index down a bit. Markets seem to be bouncing in terms of the equities, the major indices. And now let's take a look at what can we look at right now. Because there are FOMC members scheduled to speak today, multiple out of the US, the anticipation is they'll probably talk more about what Jerome Powell has already talked about, and that is they're going to ease the monetary restrictions. They're going to start to lower interest rates. And if that's what they talk about today, and maybe we can anticipate that those are the sorts of things they'll say, maybe they also talk about the negative effects of the government shutdown and how also that hurts the economy. All of that type of talk will increase the likelihood of people thinking rate cuts are coming. Okay, so if that's what you anticipate from these multiple members in the US that help determine monetary policy or help express the planned monetary policy, then it would make sense to look at something like the Euro USD or anything that's affected by changes in the strength of the US dollar. So from a macroeconomic perspective, it seems like Euro USD has reason to rise if we're talking about rate cuts in the US and easing of monetary restrictions, etc. Well, all of that would serve to put more US dollar currency in the outflow in people's hands, which could then cause inflationary movement on the US dollar. And inflationary movement means a weakening of the currency typically. So this is the fear with lowering interest rates. They want to lower interest rates and ease things up to help the job situation. But when you do that, then you also allow maybe inflation to creep back in. And when there's inflation, that means everything costs more dollars in this case, which means each $1 is weaker. And so that's why we look at maybe other currencies then to climb against the US dollar. We could look at the Euro USD. And if we look at one-day candles, we also could look at the GBP USD. And some numbers came out of Great Britain today, and we'll look at it on the economic calendar, but they were pretty good. GDP numbers, some other numbers that lend you to believe that, okay, the UK economy at least came in as expected, and in some cases a little better than expected on today's economic announcements. Pair that with expected rate cuts in the US, and you can start to understand why the pound started to bounce already today. So we're looking at Euro USD on the one-day candles right here on a resistance level. Okay, we see it touched it today and pulled back. So if we expect the fundamental news when those speakers, FOMC members, speak today, and there are multiple through the following 6-8 hours through the rest of the day, if they are in tune with Jerome Powell with what he has already said about rate cuts, then we might see the euro have some fundamental reason to break this resistance level and climb further against the USD. Okay, so we see that here. You have a couple options with that. You could put a pending order above the resistance, okay, and if it breaks through the resistance, it triggers your buy, a pending order buy up here, okay. If you do it that way, then you just, to risk manage, you would probably put your stop loss back below there, and your take profit somewhere up here at the next resistance level. Okay, and that's probably the first resistance level right there. So a breakthrough of this, pending order triggers and goes up. That's one way to handle a potential trade on Euro USD. So if I was going to do it that way, then I would say execute when price hits. Take profit at the first resistance would be 117.76, let's say. I would execute if the price hits above that resistance level, if it breaks through. So 116.86 maybe, it would be through the resistance. So execute when price hits 116.86. Take profit 117.76, that's just before this resistance right here. And stop loss, if it breaks through this resistance and runs, it shouldn't go back below. So if it could put the stop loss right where it is now, 116.55 or 116.60, somewhere in that range for the stop loss. Okay, so we've got stop loss down here below where it would enter. It would have to break through this resistance and enter up here, hoping to climb to the next level. And if it reverses, it would have to come back below that resistance that it broke through and come back down to where it is now pretty much to hit the stop loss. Okay, so that's a pending order setup, waiting for a breakthrough of that resistance, anticipating that the current fundamental news is kind of a long-term type of news, expecting multiple rate cuts in the US moving forward, and FOMC members speaking today to give it maybe momentum to break through that resistance. And if they say the opposite, if they say bullish things about, we need to not cut interest rates, we're going to keep the rates up, well, then it won't break through the resistance and you would never enter or lose. Okay, so understanding the technical setup, that there's a resistance level, and pairing that with today's fundamental news and the fundamental news leading up to today, understanding about the rate cut talk in the US, then it makes sense to wait for this to break through the resistance to confirm an uptrend. That would mean probably those members said some things about, yes, we're going to be aggressive with cutting rates, that sort of thing, and then you'd be off and running in the trade. And if they don't speak that way, then maybe it never opens. Okay, so this is the power of a strategy with a pending order that you're waiting for the breakthrough of a resistance level for confirmation of a movement in the direction that you think the fundamental news should move it. Okay, so now I like the ratio here. Possible profit 13,500, possible loss 3,900. Okay, good, but I don't want to risk 3,900 maybe. So now that I'm set up with my exit points and entry points, now I just need to adjust the trade size. So if I did one lot, now I'm risking 260. If I do 3 lots, okay, that's a little more than 1% of my account, like 1.5%. Maybe I'm comfortable with that size risk. If not, I can make this a little smaller, 2.5 lots, and I start to get closer to maybe 1% of my balance or a little over. And when I get to the amount of risk that I'm comfortable with, now I'm below 600, I'm really close to 1% risk. And there's nothing magical about 1%. You can risk more than that, you can risk less than that. I'm just using that as an example of maybe a conservative point of risk per trade that many traders might use. You certainly, especially on a longer term move, maybe you would risk a little bit more because it would take longer to get there and you'd want a little bit more profit for a longer term type move, but that's up to you. So I'm looking here, I'm risking about 600, just a hair under. So just right around 1% of my balance, a little higher, to try and make over 2,000. Okay, going after 3-4 times the amount of my risk. Okay, And it's all contingent upon the fundamental news maintaining this upward momentum that we already saw today and breaking through the resistance. Then it triggers the trade. Okay? And so if I like how that's set up, and then I go ahead and I say buy. Okay? Now it didn't buy yet. It's in the pending order section over here. It's under orders. Here's the trigger price. If it hits that price, then we're in on the trade. Until, and if and when that happens, then it opens. If not, then it doesn't open. And we have no risk at all without that opening. Now, what's another way we could place that trade? Using maybe a different risk management strategy. So if you feel like it's going to go up and you don't want to give up the current price, you don't want to wait for it to go higher, whatever your reasoning is, if you decide I want to enter now, meaning it pulled back and you think that it's just going to bounce now off of this support level here. Okay, this was support in the past, support and up, support and up, support and up. And once it broke, it became resistance. Resistance, you see how old support becomes new resistance, and it maintained resistance, resistance until this breakthrough candle, and then it became support again and bounced. So if you think you trust this support level and that this is going to go up now and you'd like to enter right now, so then you could do a market move. I can put my take profit somewhere up at the first resistance levels, and so I would enter this, I would exit this trade before the other one would ever enter. This is our entry price on the pending order. It has to break through the resistance to enter this one for a further climb. A different risk management strategy is, okay, I'll enter right now with a market move and trust this support level, in which case I would put my stop loss below that support and my take profit somewhere up this way, maybe just before this resistance. That's a shorter term type move. It's a much shorter distance to my stop loss and to my take profit compared to waiting for a breakthrough to enter. Okay? For me, this is a little more risky because it's down trading right now. The technicals on that in the short term don't look good. It looks like a downtrend. But the fundamentals feel solid still. That there's a lot of reason why maybe the euro eventually could climb against the USD from a fundamental perspective. And yeah, those FOMC members are speaking later today. And so even if this pushes down further right now, maybe in your mind you think it's going to bounce soon and you don't want to miss that entry. So if that's the case, you feel like you're not sure if it's the exact right entry point, but you want to enter now, not with a pending order, then AvaProtect is a nice option. Okay, I can protect by the hour, I can protect by the day. So if I think by tomorrow, so I can protect for say 1 day, by tomorrow this will be done with this downward movement and then go running up. Well, then I can protect for a day and not worry about downward movement. I don't have to put a stop loss because it'll stay open and protected. And if it crashes, any losses are paid back by the protection. And any gains are yours. You just pay up front the cost of the protection for that type of risk management. So if I go and say, if I do a 1 lot trade, to protect for 1 day, it only costs $208. 1 lot, that's $10 per pip. If it goes up even 20 pips, 21 pips, it pays for the cost of the protection. 21 pips is a short movement. Okay, if it even reaches this resistance level up here, or the entry price of our pending order, you're already made back the cost of the protection and you're in profit. Okay, and we can protect for 2 days if we want. Instead of 208, 2 days protection only costs $244. To me, that's a no-brainer because I'm getting double the length of time for only a little bit more cost for that protection. So I think I'll set it on 2 days protection. We do see this as bouncing off that support level. I can put 2 days protection, which by the way would protect me all the way to Monday because today's Thursday and it's 2 business days of protection. So I'll be protected from today to tomorrow and then all the way to Monday until 5 p.m. my time. I'm protected on this trade. And no matter how far the wrong way it goes, when that protection ends, any negative floating is added back. Or if it gets stopped out, any loss gets added back if it gets stopped out during the protection. Okay? When the protection ends, you get that payment. If it's a negative floating, and the trade can keep running as well. If it bounces back up, now you're making back the negative when you are already paid for the negative. So you can really get an easy profit. So if I do 2 days protection, I'm protected till Monday. It only costs $244. If I'm comfortable risking around 600 per trade, then I can do 2.5 lots, something like that. And I'm risking, let's do 2.4. I'm risking a similar amount to the pending order that we set up. Okay, so 2 days movement, we could have hundreds of pips of profit, which would be a huge payout with 2.4 lots. Okay, you can program a take profit, and let's say we program the take profit up at this resistance level up here. Okay, this was an old support level here, and then it broke below. So if I say this resistance level, I'll take profit 117.08. So how much profit would that be at 117.08? Okay, more than double or about double the cost of the protection. And since we have 2 days, we don't have to take profit so close, right? You have all the way till Monday at 5 p.m. my time. So I could look at a take profit up here where we did the pending order, 117.76. It looked good for the pending order, so why not this one? Now we're looking at 2,700 plus profit, and we pay this much up front. So if we're right on a move like this 1 out of 4 times, we're profiting. Okay, and the risk is covered if it goes crashing the wrong way. So with this setup, the cost of the protection, less than 1% of my balance, going after 2,800 profit or so. So now I have a market move. I'm in on the market. I'm protected if it spikes the wrong way over a short period of time, because I didn't need to put a stop loss yet. Let me double check that I didn't add a stop loss. Here's the trade in the open trades. I can look at edit position, and I can see stop loss. I did not put a stop loss. Why did I not put a stop loss? Because if it goes down, I don't want it to close. I'm protected till Monday. I don't care if in the short term it spikes down. I'm not losing anything. And if over the course of the next couple business days it goes up, then great. I can stick with it. I can be more patient, because downward movement, I don't lose anything more. And the protection will pay me back when the protection ends if there's negative floating. And then I can actually let the trade keep running as long as I wasn't stopped out. Okay. So 2 different ways to take the same trade. One, pending order, waiting for a confirmatory breakthrough going up. Another, protected with AvaProtect. And the third way was we could have done what I view as a shorter term move, a live trade with a stop loss below that first support level and a quicker take profit. Or not, you could have your take profit further away as well on that shorter term move. But 3 different ways to handle that trade. I simulated 2 of them. Any questions, comments on the setup of those couple trades that we went through? Okay, and if I see questions pop up, I'll address them as I see them. Someplace I want to show you real quick, the economic calendar. If you have not used our economic calendar, I think you should. There's a lot of functionality built into our economic calendar that if you haven't used it, you might not realize. Besides the announcements that already came in, you see here's the column that shows the actual, here's the forecast. This was the previous announcement, previous time that each particular announcement came out. So I mentioned about the UK. You can see the GDP went up as expected. Instead of being negative like last time, it was expected to go up to 0.1, and indeed it went up. It matched that 0.1, so that's relatively good news. It wasn't higher than expected, but it showed an increase, an improvement in the GDP month over month. Industrial production, while it missed the mark by a little, you see it was much better than the prior number. Instead of decreasing by negative 0.4%, it went up, nearly matching the increase expected. So again, positive news out of the UK with the industrial production. The goods trade balance, yeah, the trade balance was negative, but a lot less negative than expected. It's expected to worsen to negative 10.1 billion, and it came in at negative 8.29 billion. Okay, so that's a huge improvement in terms of what was expected. Okay, and it was better than the last number as well, which was 8.8. So all of these numbers coming in relatively positive. Same with manufacturing production month over month. Last time, negative 1.1%. The manufacturing production dropped, and this time it was expected to go up, and indeed it did, matching the expected rise. So a lot to be happy about out of Great Britain. We see 0.2 was expected to stay the same, and it actually beat that and came in at 0.3. Again, good news. And the same thing here, trade balance numbers better than expected. Negative, but better than expected. So a slew of announcements that were either at expectation or showed improvement from the prior numbers dramatically, and some of them better than expected. So overall positive. And if we looked at the GBP USD chart, I was actually on it earlier. It had great movement up. It was very predictable after all those announcements, and there was time to make those trades. Okay. Now, what about upcoming announcements that didn't already occur? And by the way, you could look at the GBP USD. If it spiked back down, maybe you like it. Maybe you find a spot, in this case, to buy if you think that data out of Great Britain was good enough for you. And don't forget, you have FOMC members that probably will talk about rate cuts today out of the US and monetary easing, which could help the pound out to realize potential climbs against the USD. So you have multiple factors working in the favor of GBP against USD. Okay. Now, what about announcements that haven't occurred yet? Manufacturing data out of the US coming up. How can we try to take advantage of it? We could take a look and see, okay, if this manufacturing data in the past, these are past dates when this data came in. You see half of them went up, half of them went down, but let's qualify it a bit. If this manufacturing index comes in above forecast, okay, after 4 hours, it's pretty much 50-50. 57% up, 43 down. After 1 hour, same. In the first 5 minutes, same. Half up, half down. So this announcement doesn't look very tradable if it comes in above forecast. It just doesn't look predictable more in one direction than the other. What if it comes in below forecast? What happened in the past? Okay, after 4 hours, 60% down, and pretty significantly down. We're looking at 44 pips, 36 pips, 35 pips almost, and the ones that went up not only went up less often, but went up less. So the vast majority of movement down when the manufacturing index comes in below forecast. Okay, so the USD strengthened for whatever reason the majority of the time when the index comes in below expectation, maybe because of a fear response. The USD sometimes strengthens. Now, what about in the first, say, 15 minutes? Look, they all went up. That's a relationship, that's a set of data that's tradable. And what I mean is you get false movements. In the recent history, 100% of the time, you got a false movement in the first 15 minutes. When the data on this announcement, manufacturing index, is below forecast, you get a false climb. And then after 4 hours, if now you sold, everything went down from there. Okay, huge downward movement. These were all up, and you ended up down over 40 pips on average on these three. So from 15 minutes, everything up as much as 10, 12 pips, and the longer term movement over the next hours, everything down with very little loss, maybe on one, and the rest really big gains. And so what this data does is it helps you find trends of what has happened in the past related to how the announcement comes in. For me, I see false movements when this comes in below forecast early on. So I'm waiting the first 5 to 15 minutes to see if this will spike up 10 or 12 pips. And if it does, I'm probably selling. And after 4 hours or so, I'm closing off my trades. Okay, and I would have probably a short stop loss because I see in the data that it didn't go further than 20 pips the wrong way. And if I'm getting in 10 pips already up, I can put a stop loss 10, 15 pips away. And if it follows this pattern, I am a big winner. And if it doesn't, I take a small loss if it happens to go more upward than it did these past times. Because even after 30 minutes, nothing was past 10 pips. After an hour, only one was past 10 pips. This is the one that maybe you took the loss on, and everything else after 4 hours was down. And so it's not about winning every trade. It's about following the data and trading off of what we call data-driven trading. And if you can win more times than you lose, that's the key. Okay, or win more of a payout, even if you win 50-50. If the winning is 30 pips and the losing is 10 pips or 15 pips, then that pays out as well in the end. So this data is very powerful. You can find it very quickly with this volatility tool so that you can see trends based on how the data has come in the past. Okay. I see a question. You said, what if the loss happens on Friday? Is it not better if we activate the stop loss? I'm not sure which trade example you're talking about, but we put AvaProtect on the one, so there would be no stop loss to hit there. Okay, so good question. You're asking how would we handle during earnings or macro releases. So earnings releases typically are prior to the market open or after the market close. So you want to pay attention to earnings releases for specific companies if you feel like they might move the markets as those releases come out. Okay, and so you can pay attention. You can find an earnings release schedule on something like tradingview.com and take a look and see if there are any big names. Usually it's the big names. If it's NVIDIA, Google, Apple, one of the big banks maybe is having a release. They tend to move the markets more. If it's none of those big names, then it tends to have less of an effect. So you can try to rule that out in advance. But it's also only during those times, pre-market and post-market. So when it's during the market, then you have less of an effect there. Or if you're getting in now and you plan to get out in the next hour, that's well before the earnings releases would be pre-market. Usually they're within an hour or less before the market opens if they're pre-market. Very good question. Okay, so what else can we look at on the economic calendar? Obviously, we can go to other days. So if we go ahead, and I would recommend on the weekend, going through like this for the upcoming week and pick the announcements and mark down the days and times and already look at the data that we're looking at and decide if it comes in this way, I'll trade that way. And you already have a trading plan for each announcement in advance that fits your schedule to be able to look at. And I use the high level announcements typically. And so I've already filtered out the low ones. I could filter out the medium as well if I wanted and just leave the high. They tend to move the markets more. And so there are some large announcements tomorrow as well. Building permits out of the US, inflation rate data, CPI out of the European Union. If we look at the CPI data, we might see something similar. If we look at above forecast, it's 50-50 after 4 hours. After 1 hour, 75%. So if the CPI comes in above forecast in the first hour, it's a strong movement, strengthening of the euro. But that fizzles out after an hour. After 4 hours, only one is still up one time. The rest fizzled out or we're down. So this is an immediate reaction on CPI. Within the first 30 minutes, no. Within an hour, the majority are up with one down, and then it fizzles out before 4 hours with only one staying up. So that helps you plan out the timing of your trade, not just the direction. What if this comes in below forecast? Okay, after 4 hours, 83% are down. Well, that's strong data. It's not down a lot. Average range movement 24 pips, but it's down. So now, what if there's a false movement in the early goings? So after 4 hours, I expect downward movement on the Euro USD if the CPI comes in below forecast, meaning the Euro weakens with weak CPI data. It makes sense. What about in the first 15 minutes or first 5 minutes? Okay, I see false movements up. 1, 2, 3, 4 of them are up, and the 2 that are down 1 pip, 2 pips. So more upward movement than down in the first 5 minutes. After 4 hours, almost everything down 20 to 25 pips, with one exception. So this Euro USD, if the CPI comes in below forecast, what we see is the trend, false movement in the first 15 or 5 minutes, and then the movement that you might expect in the longer term, the Euro weakening with weak CPI data and ending up down the majority of the time. Okay, so very easy to work out a trading strategy with this type of data. Okay, so there's a question about trading on gold, and I would say any instrument during high volatility times, meaning you're waiting for the CPI data out of the US, which is one of the biggest trading numbers that people look at, or maybe the non-farm payroll numbers out of the US. And I keep mentioning the US because it's the most heavily traded announcements, because the US has the largest economy in the world. So if you have a major event like that, an NFP, CPI data, and you're trying to trade on the announcement, you will have slippage the majority of the time. And the bigger the surprise the numbers are, if they're way above expectation, way below, you can have gapping and even more slippage. So I do not recommend putting a pending order just above the price and a pending order just below the price right before a big announcement and think that, okay, whichever way it moves, I'll get in and make a quick profit. What happens is it spikes up, it spikes down, you get slippage on both of them, and you end up losing both trades. That happens more times than not. So I don't recommend pending orders around major high volatility announcements, because more times than not, you're not going to get the entry price you want, and you end up unhappy. Why? Because the prices move faster than the servers can even process the trade. If it takes 3 milliseconds to see your pending order, process it, and open that trade for you, if the market moves 30 pips in 2 milliseconds, and it took 3 milliseconds to open your trade, when the market's moving that fast with these large high volatility announcements, the systems just can't open your trade at the exact spot instantaneously. There's slippage because the market's moving faster than the processing of the system that opens your trade. And that happens with every broker, no matter where you trade. So I would advise, be very careful with pending orders. If you're doing scalp type trading, very short entries and stops and take profits, if you have a stop loss of, I don't know, 15 pips and a take profit of 20 pips, and you're trying to use a pending order with a high volatility announcement, you might not be anywhere near the entry that you wanted. And so your entry might be at where you wanted to take profit, for example. And you're going to say, what happened? I should have won. Well, it didn't open on time because the market's moving so fast. Under normal trading conditions, that doesn't happen. But high volatility, yes, be careful with pending orders. Unless it's a longer term move, then that's okay. Stop loss is 100 pips away, take profits 200 pips away, something like that. Okay, a 10 pip slippage isn't going to harm you as much. But again, it's up to each trader how you handle those types of situations. But very good question. Okay, so what are we looking at here in terms of other announcements? We looked at the CPI, very predictable. It looks like false movement, and then you can trade on the secondary movement based on the past data. We can also look at other announcements coming in, building permits out of the US. I think you'll see similar false movements. If this comes in above forecast, after 4 hours, 80% down in the first 5 minutes, look at that, 80% up. You talk about false moves, okay? Building permits come in better than expected. The USD weakens in the first 5 minutes. Euro climbs, majority of the time. After 4 hours, everything went down from the point that it was at after 5 minutes. And again, this looks small, but it's not small because on average, they're down around 15 pips, 15 to 20 pips. And in the first 5 minutes, They went up 5 pips or so. So that's 20 pips movement. You can make a nice profit with that type of movement. 15 minutes, they were up even more. So looks like in this history, you're looking for at least 5 to 10 pips, false movement, and then looking for the longer move to be down if building permits come in above forecast. Okay, so doesn't mean you're going to win every time. You know, statistics are what they are. They show what happened in the past. It's no guarantee what will happen each time in the future. But if you try announcements like this, and they're every week, each month, it's the same announcements. They're repetitive. Try each announcement. For example, the building permits month over month out of the US, try them 5 or 10 times over the course of a few months. And if you win 6 out of 10, or maybe you win 5 out of 10, but you win more than you lose each time with how you set up the take profit and stop loss, then you know, okay, that one adds to your permanent list. You'll use that announcement moving forward. Find the ones that work best for you, and then you use those as part of your bag of trading strategies. So you're diversified with your trading strategies. So this economic calendar is just one example of the tool, a tool you can use to trade within our platform and within our app. Remember, we looked at trading directly off the macroeconomic news. It's the Euro USD trades that we were looking at, or GBP USD we could have looked at based on the larger fundamental news of expectation of rate cuts, etc. And then we can also look at specific articles in the market buzz. Okay, and we'll just finish on this. In the market buzz, we can look for specific instruments. Maybe you say, okay, AMD, I haven't heard of that maybe, or maybe you have, but it's trending more than you expect. You know, we expect NVIDIA to be trending the most. It's the biggest circle here. Many times that, and Tesla and Apple, but AMD, maybe it catches your eye and you say, okay, advanced micro devices. What's going on with this company? Why is it trending so much? You see price may rise 18%. So you can get the technical breakdown. You click here and you get the technical setup. It shows you the take profit up here on 263. It's expected to climb. It breaks down the technical aspect of things here. So the technicals are there, and you say, okay, the signal says buy. What's the most recent news? And you can find news right here that's most recent that's found about this particular company. Okay, so you can scroll down and see it is, there's something interesting to read. AMD's stock just keeps climbing, and it all comes down to this factor. Okay, that sounds interesting. I'll bite. Let me click that article, and let's read the article. Here it is. It takes you to the source of the article. You can read about why is AMD climbing so much. Okay, they go on to talk about signing lucrative deals with other companies and that their supply chain is improved and revenue growth. So if you read that article, maybe that helps convince you whether you want to follow this signal, using the most recent fundamental news to filter which technical signals you trust and which ones you don't. Okay, and I can scroll down, look for more articles. AMD partners with OpenAI. Wow, that sounds good. OpenAI, it's like one of the biggest things out there right now, and AMD partnered with them to provide chips. Okay, so if you see enough positive news, maybe that leads you to say, okay, maybe I want to buy on AMD. Okay, great, let's go to the charts. It's not tradable until the US market opens because it's a US company. But let's look at where's the chart. If it's expected to go to 263, where is it now? Okay, big gap up. That's probably when we found out they're partnering with OpenAI. That's big enough news that maybe the momentum continues. The current price as of the close yesterday is 238. Okay, I drew a line up here at the resistance level or not resistance, but the take profit level that signal said it might climb to. That's, you know, if it climbs the 20% or so that they're talking about, that's here. This is the take profit area. So what we're looking at then is a potential move, depending how this opens. If the market opens and it looks like it's uptrending, maybe you put your stop loss below the open and you see if it'll climb towards where the signal says it might go. If you and the news might help you decide that you trust that move. maybe it opens with a gap down. And you say, oh, something's wrong. Why is it gapping down? And maybe the technical move doesn't confirm what you expected to see. And maybe you decide, okay, I'll wait. And maybe you put a pending order. And if it breaks back above, you buy. Or the opposite. If it's dropping, maybe if it reaches a support level down here, you still buy. Why do you keep buying off of support levels or buying if it breaks the resistance? Because of the fundamental news. That's the direction maybe you trust, okay? So you look for confirmatory breakthroughs that confirm the fundamental news, or a nice support level that you trust when you have positive fundamental news in this case, okay? So either way, confirmatory breakthrough, pending order here, and also a pending order down here on the support level if you, indeed you feel like you should buy. Either entry point would make sense. And maybe you put half the trade size you would normally do here and half the trade size here since you have two possible entries, okay, to handle the risk management side. Any questions, comments on that with the market buzz, how to use that? Okay, great. I don't see any more questions popping up. Thank you all for attending and also for participation with the questions and comments. It's very nice to have questions because as I answer them, it helps other people as well that maybe didn't think of the question, but the information is still helpful for them. So it's great to have the participation as well. Thank you all for joining and good luck with your trading the rest of the week. And I'll be back at it next week with more sessions, same as this week. Wednesdays, 7 p.m. UK time and Thursdays, 11 a.m. UK time. All right, everybody, bye for now.